Federal Reserve has printed over $4 trillion of base money. And that's M0, so-called, and our M1 numbers are going up even more. People go, well, look at all these trillions of dollars the Fed is printing. We're going to get inflation. No, we're not anytime soon. Money printing does not cause inflation. The Austrian school says it does. A lot of the libertarians say it does. It doesn't. We had money printing with QE 1, 2, 3, and 4 from 2009 to 2019. We never got serious inflation, and we're not getting it now. Money printing does not cause inflation. What does cause inflation is velocity. That's the turnover of money. An example I've given before, I go out to dinner and I tip the waiter, and the waiter takes a taxi home and tips the taxi driver, and the taxi driver takes the tip money and puts gas in her car. Well, in that example, my dollar has a velocity of 3. It supported $1 supported $3 of goods and services. The waiter tip, the taxi tip, and the gasoline. But what if I stay home and watch TV? Well, now my money has velocity of 0. My money's still in the bank. I didn't spend it. And I remind people that $7 trillion times 0 is 0. That's the quantity theory of money. In other words, it doesn't matter how much money you have. If you have low velocity, you're not going to get nominal GDP. You're not going to get the growth. Just to give an example, in the fourth quarter of 2007, velocity was 10.7%. It means every dollar supported $10 of goods and services. Today, it's around 3.5%, meaning a dollar only supports $3 of goods and services. Velocity has plunged. In the first half, if you look at a chart, in the first half of 2020, it looked like an Acapulco cliff dive. It went straight down. Someone asked me the other day, how low can velocity go? And I said, well, technically it can go to 0. I don't think it will, but even if it goes from 3 to 2, that's a 1/3 decline in nominal GDP, all things equal. So the Fed has to print money just to keep the economy from collapsing, but you're not getting inflation. You're getting 0 interest rates, and people said U.S. interest rates have gone up recently. They're referring to the yield of maturity on the 10-year Treasury note. That's not a short-term rate. That's an intermediate-term rate, or even a long-term rate. Okay, it's 1.6%. Well, a few years ago, it was over 3%. So it has gone up from 60 basis points to 160 basis points, but it's still lower than it was during the last spike. It's a pattern of lower highs and lower lows. The trend is still down. So interest rates are dropping. Fiscal policy has no stimulative impact. And people say, well, how can that be? You had a $1 trillion baseline budget deficits in fiscal 2020, fiscal 2021. Donald Trump put on $3 trillion of additional deficit spending on top of that. President Biden so far has put on $2 trillion of additional spending. So that's 5 plus 2, so that's $7 trillion of deficit. And the Biden administration is planning $4 trillion more later this year, which they're going to get probably before September. So that's $9 trillion of deficit spending. When going into this, the national debt after 230 years was only $22 trillion. So you just put $9 trillion of deficit on top of $22 trillion. It took, again, 230 years to get to 22, but we got to 31 real fast, just in 2 years. Well, doesn't that mean the economy is booming? Again, the answer is no. And the reason in the United States, this is not true in Australia, by the way, but it is true in the United States. Our debt to GDP ratio is 130%. That's one of the worst in the world. If you said, well, who else is kind of close to that? The answer is Italy, Lebanon, and Greece. There's your lunch table. Is that the group you want to be compared to? Even countries in Europe that are more more socialist than the United States, that the Americans like to make fun of in terms of fiscal irresponsibility, are better than we are. Spain is about 90%. Spain, France are well below 100%. Germany is even lower, closer to 60%. The US is 130%. And so what happens is, and the research on this is very clear, when you go past 90%, when your national debt is more than 90% of your GDP, your so-called Keynesian multiplier, fiscal multiplier, drops below 1. Now, what does that mean? Well, it means that at lower levels of debt, so again, Australia would be a good example of you have 30 or 40% debt to GDP ratio. If the government borrows a dollar and spends a dollar, you can get more than a dollar of GDP. You can borrow a dollar, spend a dollar, and you can get $1.25 with GDP. So that's the stimulus that has some stimulative effect. Whether that's temporary or permanent or just bringing demand forward, that's a separate debate. But it does work that way. Borrow a dollar, spend a dollar, get $1.25 of GDP. But above 90%, you borrow a dollar, you spend a dollar, and you get less than a dollar of GDP. You might only get 90 cents or 80 cents or even less. That's where the United States is now. But the result of that, and again, this is simple math, is if you're increasing your debt by a dollar, but you're only increasing your GDP by, say, 80 cents, what's happening to the debt to GDP ratio? It's going up. In other words, there's more debt being piled on top of a given amount of GDP. The ratio is going up. Well, the ratio is the problem in the first place once it's over 90%. Now you're making it worse because you're still borrowing and spending, but you're not getting the GDP to support to go along with that. Your Keynesian multiplier is less than 1, so you're just digging a deeper hole. That's why you can't borrow your way out of the debt crisis. So monetary policy in the US won't work because of velocity. Fiscal policy won't work because the debt to GDP ratio is too high. And there's a behavioral adaptation. People look at that. You don't need a PhD in economics. You just say to yourself, hey, I don't know how this is going to end, but they're either going to have inflation or they're going to raise my taxes. The third way out is default. But the US doesn't have to default because we can print the money, at least for now. But people say there's going to be inflation or taxes. They're both bad outcomes. So people save more. It's called precautionary savings. And guess what happens? When you save, you're not spending. So that affects consumption. And that's another reason that the economy is slowing down. So the US forecast, I'm not forecasting a second recession, but I do forecast a continuation of a depression, much slower growth than expected for the reasons I mentioned. Let me just kind of recap a little bit and go through some recommendations for investors. I recommend a decent sized allocation to cash, perhaps as much as 30% of your portfolio. And people go, well, wait a second, cash has no yield or practically no yield. What good is it? I want stocks, or I want things that are going up. Well, okay, but cash has a lot of hidden benefits that people underestimate. One is that, first of all, it reduces the overall volatility of your portfolio. So if you have volatile assets over here like gold or real estate and other volatile assets like stocks and bonds, a slice of cash in the middle will reduce the overall volatility. So maybe you can sleep a little better at night. People worry about inflation, fine, but I would suggest that deflation may be a real problem, at least for the next year or two. And cash can be your best performing asset in deflation because the real value of cash goes up.